The American market is extremely bipolar at the moment, and it feels like the sort of market that can go on a tremendous bubble. SpaceX is the signal pistol going, and go bang, off we go into the bubble. SpaceX, after all, it's the biggest opportunity in markets of all time, because it's the whole universe to play for. What's the top of that? Because soon enough we're going to need to know.
Kevin Warsh has now officially been confirmed as the next Fed chair as of May 13th. Since then, the bond market has been selling off, with the US 30-year climbing to a 19-year high of just under 5.2% this morning. With bonds selling off, stocks continuing their euphoric rally, and precious metals stalling, is now the time to rotate into risk. Clem Chambers, founder of ANewFN, joins us now. This video is sponsored by Kalshi, the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below and use my code LIN, L-I-N, or scan the QR code here. New users get $10 when they trade $10, and for example, you could put $50 down on the odds of a recession happening this year, which, by the way, is something we'll be discussing with Clem. And if the trade turns out to be correct, you could yield $262 on $50 put down this trade. Clem, welcome back to the show. Good to see you.
Well, I'm spending my assets outside of the Western Hemisphere. I'm in Hokkaido. I'm swimming around in the hot springs full of crazy critters, and foxes running in the street, and bears in the woods doing what bears do in the woods.
I appreciate you spending time with us to speak with us while you're on holiday. Clem, the 10-year yield jumped to 4.6% today. And, you and I have been talking about allocating assets outside of the 60-40 portfolio for quite some time. And the fact that the 10-year has jumped so high since the beginning of March is indicating what? Higher inflation expectations, higher economic growth, or perhaps just a failure in the bond market up ahead?
Well, probably potentially all three. And a new guy at the Fed who's meant to be a hawk. Because, the solution to all these problems with interest rates and all that good stuff is well known, and it's called QE. And if you've got a guy with his hand on the lever that refuses to pull it and says, no, let the bond market do its thing, then that would be pretty interesting. Yeah. But I don't think that will happen. But there's the doubt there, because, I was reading some news saying he was a hawk just a few hours ago, saying how he was, pretty much old-fashioned in his attitude towards things, and there'd be none of this QE. That was all a big mistake. We won't be having any of that. Now, I don't actually think that's going to occur. But you then got all this build-out. You've got the onshoring of the whole of the American economy that has been offshored over a generation or even two. So somehow that's got to be brought onshore, and that's take funding. And then you've got the AI build out, which is going to take a huge amount of funding. It all takes a lot of funding. And then if you look at all the normal companies, which many of them have, are relatively well levered up one way or the other. If all the money gets sucked out for AI and for other projects, onshoring, etc., well, they're going to need money too, aren't they? So they're going to have to print some for them. So you're looking at a printathon, which is inflationary, and you're going to look at a market saying, well, where's this money coming from? And if you've got a hawk in the Fed saying, well, you'll have to find a way, won't you? Then you're going to get higher interest rates, and inflation is coming for sure. It's about to land. Everybody says, obviously, the situation with oil, that's going to create inflation. That's not the big deal. That's not the big deal at all. The big deal is all these build outs that are going to suck all the money out of the system and into basically capex, massive amounts of capex. America's not used to massive amounts of capex. It's used to the opposite. It's used to getting its capex down in many ways, outshoring the capex. And now it's got to reverse that trend. So, we are in a very, very big change. And obviously, when things change dramatically, you get volatility, and you'll see that in the bond market, and you'll probably be seeing that in the equities market at some point.
You and I are both traveling overseas, Clem. What has traveling taught you about investing? What have you noticed about other cultures, or how other people are run in other governments, how other countries run their business? that has made you think about where to put your assets? Let's put it that way.
Well, I mean, I put the bulk of my assets in my motherland because it's so blooming cheap. And what I notice about the world is it's a lot more ahead than a lot of local people in various countries, including America, think that it is. So, the British think they're pretty cool, most of them. But when you look at, say, what's going on even in Istanbul airport 10 years ago, makes Heathrow look like the dump it is. So, in America, going to be great again. But when you look at what's going on in China, maybe it's no longer such an exceptional country. It's no longer the number one, perhaps even. So the realities around the world change, and people back home making all the big decisions are quite often out of touch with how things are going. If you go to Mumbai, you will see that that's a place that changes every 90 days. You can feel the change every time you fly back 3 months later. It's moved on. And you can't really say that about many places in the West. So, I think the big picture is what you get from traveling around. And the big picture gives you a better perspective. And you can find things that are mispriced better by seeing, a bigger picture. And the UK, for example, well, if you look at the UK, 1 time sales, look at America, same company, 4 time sales. Okay, well, something's wrong with that picture. And I'd like to think that it's a good investment to buy the cheap ones and wait for them to be no longer cheap. So as a value investor, I love the UK market, which is completely broken, absolutely broken. The companies aren't. The companies are international, but they're operating in a local failing stock market. And that makes those companies prone for takeovers. Oh, there you go. There's a nice little payout when that occurs. And or a change of fortune, which obviously would then set the whole market in a good shape. And you saw that in Japan back in, I think, about 2010. I can't remember. I was there at the time thinking, oh, Japanese market's going up. Oh, that's rather good. But, if you were Japanese, you would have looked at it and not seen that coming. Because from your perspective, everything was gloomy and slow, and it was great once and it's never going to be great again. But as an outsider, you could look at their market and go, this market's going up. Look at that. That's going to go up any minute now. And it did.
What does being diversified then mean to you in 2026?
Well, I mean, there's many ways of looking at diversification, and most people do not look at it. They are not diversified. They have some things that they love, and buy and hold and buy the dip and all that. And they're undiversified. And oh dear, that's just such a bad place to be. I mean, I follow all my portfolios, all my diversified portfolios for the last 30 years. I can still see what happened to them all. And what you get is a couple of big winners. And all the other ones drift away. Some of them go broke. A lot of them get bought out, and a few of them don't go anywhere at all in 25 years. But a couple of them will go mental, and the whole success or failure of that portfolio then ends up being in the hands of a couple of companies. Well, they swing around incredibly, and I'm sure there's plenty of people out there holding Nvidia perhaps for the last 15 years, and every day they get a lot richer, a lot poorer, because all their money is concentrated into an undiversified portfolio of risk. And if you've got an idea of where you should invest, you should always spread those bets around. And if you've got some theories, you should then break them down into bits. So you see, rather than have it all in Nvidia, if you think that silicon was the place to be, you just don't have it in Nvidia. You have it in AMD, you have it in Intel, you have it in all the chip and software companies, you have it in all sorts of different places. And that way you can be undiversified in that sector. But me, I just look for anything cheap, and I am undiversified as a value investor. So I'm strongly concentrated into cheap stocks, and I don't care where they are around the world. So I'm diversified around the world. I'm diversified in sectors because I don't care what sector they're in, but I'm still end up undiversified when it comes to the thesis that I have. But of course, if you want diversity, just buy the S&P 500, and then you'll be in pretty good shape.
I had this discussion with another guest the other day. What if we just buy the S&P, leave it alone for the next 30 years, and stop trying to pick stocks that will outperform the market? Because the vast majority of professional investors don't do that. or can't make it, what chance do I have, is my thinking.
Most professional investors, it's their job and they blooming hate it, and therefore they're not very good at it. Okay. And anybody that doesn't love it should definitely not go stock picking. I mean, it's like, so why hit a little white ball around a big lawn and get it stuck in sand and try to get in a little hole at the end? Who'd want to do that? Well, don't bother with that. Just set up more as television. That's pretty sound. But, if you love golf, you'll go out in all weather, won't you? And I love stock picking. And the reason I'm good at it is I love it. And if you love it, if you enjoy it and you study it, it's like any pastime. There's work and I don't work to live, I live to work. And the life that I like the most is in the financial markets. I absolutely enjoy picking stocks and finding out what's going on and working out how it all fits together and spotting something that's going to occur like gold or Bitcoin or whatever, or top of the market or a crash that's great. And if you are like that, then there's very good money to be made. If you just want to invest, buy the S&P 500 and then go play golf.
Yeah.
Go walk around in all weathers, hit a little wide ball up and down grass.
People have started trading directly on events instead of just investing. And this is a prediction market, Cauchy, odds of a recession this year. You'll see something interesting, Clem, that the odds of a recession spiked during the onset of the Iran war, and that odd has since rescinded, and the probability has perfectly inversely correlated with the S&P 500, which has dropped around the same time that the odds of a recession has peaked on Cauchy, and then it climbed when the odds came down. What has happened in the last month and a half that has calmed investors down and I guess shown the markets that although the Iran war or conflict has not yet been resolved, it will not damage the economy to an extent that previously was thought?
Well, see, in my model, what happened was it kicked off in the Gulf, the market began to crash. The government, or whoever it is in the government that does this, pulled the lever, pumped in a huge amount of money into the economy, go straight into equities, up they go like a rocket. And as that money takes its effect and loses its potency, it curves over. Happened with the Trump's tariff tantrum. Same thing. Bang, a massive amount of money goes in, up it goes like a rocket, over it goes as the money diversifies and flows into the economy. And you're seeing that again. And so the market will kind of curl over as the potency of that bazooka wears off because it spreads into the economy and into asset prices. Now, as far as things like Cauchy goes, I mean, unless the people driving the price are insiders, then it's just gambling. And, it's how people feel about it. Now, maybe they think there's not going to be a recession because maybe they're just getting bored with it. So that price is going down because people are getting bored. They're just less scared. They're less worried. So the price is a sentiment indicator, but not necessarily a predictor of the future. And after all, if it was, people wouldn't play it, would they? Because there would be nothing that they could see that wasn't already in the price. And I don't think... I don't know. It's gambling. It's very successful gambling and everybody loves it and everybody loves to gamble. And poor old crypto, all the gamblers are probably over in the prediction markets now rather than chasing after some animal meme coin.
Yeah.
But
So
it is, the markets are a lot about gambling because people get a lot of a thrill from the dopamine, etc. And, you can't get the gambling out of the markets. And that there you go. But I prefer not to gamble. I prefer to be on the other side of the trade.
I think the level of gambling and the risk on sentiment correlates with what the perceived, put it this way, how investors perceive the markets to perform in the next 6 months will directly dictate the level of risks on sentiment and the level of gambling there is in the market. So is right now the time to take on additional risk?
Well, there's a risk is a double-edged sword. Okay, I always say some person will come to me and say, "Oh, there's this little stock, some micro cap pink sheety thing," and they say, "Is it too risky?" And I say, "No, there's no risk involved in that share. You're guaranteed to lose your money." Yeah, there is a curve in risk where it does equal reward, and after a certain point, risk just equals loss. Yeah, and it doesn't just go, oh, this is incredibly risky, therefore I'm going to make an incredibly great reward. It means your likelihood of loss at some point doesn't balance with your potential gain from getting it right. And I think the American market is in a bubble now, which is a very risky situation and also a highly profitable one. But you are guaranteed that there'll be a crash. It's just a question of when, and I think that's about 2 years away. I might be being optimistic. It might be 2 weeks away, but I think we are definitely in bubble territory now. And a bubble is a fantastic thing if you can get it at the bottom. And I think this is near the bottom of this bubble. And I think SpaceX is the signal, is the pistol going and go bang off we go into the bubble. SpaceX, after all, it's the biggest opportunity in markets of all time because it's the whole universe to play for. I think someone was saying that today, and I thought, oh no, the biggest opportunity in the markets in history because it's the rest of the universe we're going to go to now. So that's probably true. But it's the sort of thing I don't want to hear in the markets because that's the sign of the sort of enthusiasm that leads to people in a period of time going, oh, it wasn't me, I didn't do it. They said he was going to do this, and it's all their fault. Oh, mummy, it wasn't me. Yeah. Oh, I lost all my money. Someone else's fault.
The reason I ask this is because even in prediction markets, traders are predicting that the odds of a recession are coming down. And certainly the stock markets are reflecting the sentiment. Would you chase this kind of sentiment right now? Is my question.
I think you have to chase these, not sentiment. Sentiment will always get you in trouble. Yeah, because it's a group of men acting like one fool. That's what a market is, and it's sentiment. It's reality. And when sentiment runs away from reality, that's where you've got opportunity to make money. And so I like to look at things where the sentiment is terrible and the reality is a lot better, like Intel a few months ago when it was 20. Yeah. 120? No, I don't know. Not only don't I know, I don't actually care. Yeah. We're in a bubble. So that's my thesis. So I'm going to ride this bubble until I make too much money, and then I'll stop and I'll jump off and everyone will tell me I'm a fool, and then it will keep on going for a bit, or probably quite a lot, and then it'll come crashing down. So at the beginning of a bubble, I plan to ride that bubble and see where it leads, and listen really hard for the guy ringing the bell at the top. And because valuations are just so high, they're historically high, and they're, the horse is out of the barn on price, and it will run. We're in a bubble. Bubble bust follows. Yeah, boom, bubble, bust. Well, we've had the boom. We've entered. I don't think we're entering it. We've entered a bubble. It probably has 18 months to 2 years to run. And you'll know when it's got 3 or 4 months to run, because there'll be a load of crazy IPOs come out of nowhere, that will be never heard of. That will all be, oh yes, Elon Musk ex-girlfriend's brother-in-law has built himself a factory within 50 miles of SpaceX or something. There'll be that kind of thing, just like it was in 2000. You will see a load of crazy IPOs hit the bricks, and that'll be the time to leave.
Well, with the stock markets at all-time highs, the 30-year Treasury yield at a 19-year high, where would you go right now?
Where am I putting my money? I'm putting my money in the second and third order things that are involved in the onshoring and AI build out. So, if anybody makes generators, I want to buy their stock. Well, I don't, because they're already expensive. Yeah, I'm looking for people. Well, electricity grid is interesting. Yeah, so I don't want the electricity grid, because they're going to be kicked about by government as being, you're bad people, you haven't got enough electricity because we told you not to. Oh, whoops, that don't make sense. But anyway, you're bad people, stop that. So they will be punished just by being there. But people that are supplying them with, big switches and transformers and big cables to take power, they're going to be having a great time. So anybody that is going to be building out into the AI build out, anybody who's not in the way of the government idiot, I'm looking to buy stock in, and I've bought a few, energy companies and people that build nuclear power stations, that sort of thing. And a lot of this stuff is a bit further out than I'd like. I mean, like uranium's going to be a big deal, but it's not quite a big deal yet. Copper is going to be a much bigger deal, so that's got a long way to run. So anything copperish is good. So copper miners are going to be good. You can make mistakes though, because you can say, like, you could buy a company that makes wires. You think people are going to want wires, but unfortunately the cost of the wires is going to go up so much they might not be able to pass the cost through. So there's lots of things you've got to be careful of. But anything to do with the onshoring and anything to do with the AI build out, particularly the AI build out, is going to be very, very, very spicy.
Yeah. Meanwhile, the UAE has built nearly 50% of a second pipeline that's supposed to bypass the Strait of Hormuz. It's not supposed to be operational until 2027. Now, the market concern is that the Strait of Hormuz remains closed indefinitely, probably until 2027 or even beyond. And so a pipeline or multiple pipelines bypassing that is much needed. But for now, since we don't have a direct fix, is oil going to nearly $300, which is what we discussed last time?
Well, it's such a wild card. I mean, what is the American strategy? For me, it's just, have a siege, let the Iranian oil infrastructure break or be highly damaged. I mean, it would appear, I don't know whether this is actually a thing or not, but I've seen photographs, you don't know these days whether AI or not, that the Iranians are actually pumping oil into the sea rather than have it back up. Yeah, so if that, what a catastrophe that will be if that's what they're doing. But, if America, if they found a way to stop their oil production from breaking, then the siege isn't going to work. And then what? So I think it's all up in the air. But yes, capitalism always finds a way. So I didn't know the EIA had built half a pipeline already. But I don't find that hard to believe. And my position has always been it'll take them about a year to find a way around these things. And they will find a way around it. Capitalism always finds a way. So, yes, that will flush through. But where that leaves the Middle East, I don't know. I mean, the big call is China. It was Trump in China. That was the big event. And that turned out to be nothing but a bug, which is probably quite a good thing. Yeah. So, it's China and America. Can they do the right thing for their people and muddle along? If they can, we've got a great future, absolute great future. If they absolutely insist on mucking about and, increasing hostilities, then it's going to get really bad. But I think that, one way or another, that the world's had a wake-up call. I think China's had a wake-up call over Taiwan. I think America's had a wake-up call over China. I think, Russia's about to get a wake-up call. And so we might go out, please, in a couple of years, out of this, situation of high volatility into some more stability. And that will be good. But, the technological advances that are going on across the board right now are so powerful that as long as we don't go down the road of NS, i.e. natural stupidity, the future is very, very rosy. But of course, there's always the lunatics, driving the bus that can make this stuff go wrong. And there is a lot of lunatics driving many buses out there. So I hope that they can, the world can get a little bit more stable. And because if it does, it's going to be great. We'll still get a crash, but
I was just in Singapore traveling, and Singapore is renowned for many things, among which a very stable monetary authority and government policies that are predictable. I wonder then, for an investor, instead of waiting for the world to become more stable, why not just put your money in more stable jurisdictions?
Oh, sure. If you've got that much money. Yeah, you need to be geographically diversified if you've got more than a pot to, whatever. Yeah, if you've got a bit of money, it makes sense. The classic is to put 25% in productive assets in your country, keep 25% in equities, keep 25% in cash outside of your country, and keep 25%, in your back pocket. So, spreading your assets geographically makes perfect sense. And diversification is great, but most people don't have enough capital to need or to be able to diversify that far. And so for them, the best thing to do is, have a little bit of bonds and a lot of equities, and put them in ETFs and let it run. And that's worked out extremely well. And I think, if you were to buy and hold from here, you're going to have a couple of good years, and you're going to have a really terrible one, and you're going to have 5 years of wishing that you had done something, and then 5 years later you said, oh yeah, that was back then. So that's the thing about buying, hold, and holding. If you do it judiciously, then it's a very solid way of going, and ETFs are the less a demanding way of doing that, because you are just buying the index, or you're buying, I like semiconductors, I'll buy the semiconductor ETF. Oh, I like rare earths, I'll buy the rare earth one. Oh, I like China, I'll buy a China ETF. And it simplifies you out quite a bit. But most people just don't want to put in the effort. It's boring and they don't enjoy it. So that's why they don't want to do it. And I totally get that.
By the way, let's talk about gold before we finish up. It's underperformed the S&P 500 this year. It's had a great year last year, beating most things. And this year, I suppose if you're a gold investor or investor having allocated to precious metals last year, should this year be the year of rotating out of precious metals into something else?
Well, I've been gone since the high. So, and now I look at it and I go, well, it's kind of... it's being stodgy, isn't it? People, my audience keeps saying, when are you getting back? When are you getting back? And his point is, it's just another asset. And when I was, writing a lot about Bitcoin when it was going up, and when I got out and everybody was upset with me, it's just another asset.
Yeah.
It's just, one should focus on that. It's a very, very popular asset. It's a lovely one to own. So you get kind of warm and furry dividends from it. But it's gone up a lot. I think it's very dependent on the America-China dynamic. And I think that has been pushed out somewhere. I think it's very dependent on the parallel trade situation with people like Russia and Iran using gold as their deposit account in China. So I think you'll find when Iran sends a boatload of oil to China, the Chinese pay them in gold, because they don't want to pay them in yuan, because they don't want to be the like the dollar, the global asset, the global money, because they don't want to be in that situation. So they're just paying gold, and they just keep the gold for them in a vault in China. And when Iran wants whatever it wants, it turns its gold into whatever currency is needed, and away it goes. So a lot of gold's been going into China, because if you take for example, Iranian budget surplus in oil, it's about 16 to 18% of the global production of gold every year. So if they're stacking gold rather than holding dollars, and why would they want to hold dollars? Because they're at risk. And they can't get them into Iran because China doesn't want to be the reserve currency of the world. What makes more sense than to just buy gold? Well, that's a sum of 1/5, or a little bit less than 1/5 of all the gold that's being made every year out of the ground. And of course, then you've got to add Russia on top of that. So anybody that's using gold as the reserve currency rather than the dollar because of all the sanctions, that's eating up a lot of gold, and that's being held in China for those trading partners. But that could go away. I mean, imagine the situation where Iran played nice and it was allowed to, re-enter the global fellowship, or for that matter, Russia. If that war ended and Russia, made nice and was allowed to come back into the system again, that trade would go away. So that would be really, really, really negative for gold. So, it's done its run. And now it's in that post-boom bubble situation. Now, whether it sits here or whether it takes a leg down, taking a leg up, highly unlikely. Will it trend around here? It doesn't look like it knows where it's going. So gold is a signal for me now, not an asset. So I look at gold, and the direction it goes tells me about what's going on. Like oil. When oil goes up, you know it's not going well in the Gulf. When oil goes down, it might be, things might be developing. So I think it's a very good signal for what's going on in the global economy, because what drives that price is driven by people that know what's going on right at a very deep level. So it gives you an insight, a hint of what's going on. And I think at the moment it's had its moment, and that moment is not likely to come again for quite some time.
Quite some time, probably 2 years, around the same time you think the stock market's going to crash?
What tends to happen, and this is, past performance, etc., is when a commodity goes nuts, it falls like a rock, and it flaps about and it goes all quiet, and then it has another run. But if it went from, say, 1 to 10, it'll come back down to 3, and it'll go around sideways, and then it'll go to 6, and then it'll come back down again. So there's like an aftershock. So I would expect there to be an aftershock in a couple of years, because a lot of people will be watching it, hoping that the music will start again. Yeah, because they loved it when they sat there for 5-10 years saying that gold's going to the moon, and then it did. And they feel validated, and they made a load of money, and then half of it went away again, and they feel sad, and they're watching it because they know they were right. So there's a sort of married to the asset thing that goes on with commodities like that. And if you look at the 70s, you'll see these aftershocks over and over again. So there will be an aftershock in gold, and there will be an aftershock in silver. The one that's going to run is going to be copper. So that's the one that I'm watching. That's the one I'm expecting to have a big run.
Okay. Well, let's talk about copper in more detail next time. Final question before we take off, Clem. Thank you. What has shocked you this year? Which asset class or which trade has gone in a way that you haven't expected maybe late last year?
Well, when I looked at Intel at 20 and bought a load and accidentally bought a double load, I thought, this thing could go to 60. And because of the situation in the Gulf and all the craziness of announcements, I got out of the whole market, and I got out of 45, which I did exceptionally well. I'm very happy with that. And 80, I would have definitely sold, and there it was hit 120. So I think that surprised me, because that tells you how badly wrong the American market can get something very obvious. Yeah, and I think that is quite interesting, because it shows you that it's quite a highly strung market and can move very irrationally, very quickly. And you can see the same thing going on as happened with Nokia, which is a great company. And then suddenly it took a long time for the penny to drop. It took a long time for people to work out what was going on there. And I would have expected the American market to be hyper efficient, hyper quick. And no, it's got all sorts of opportunities lying around in it that I've been looking at going, I don't believe that. Why is that like that? And then looking at some very average stocks with incredible valuations that beg a belief. So, it seems to me that the American market is extremely bipolar at the moment. And it feels like the sort of market that can go on a tremendous bubble. And the point is, what's the top of that? Because soon enough, we're going to need to know.
All right. Well, thank you very much, Clem. Tell us where we can find you and follow your work.
Well, you can hear me ranting and raving on Clem Chambers Alpha on YouTube here. And my Substack is quite popular, where I put lots of ideas down so that people can be a little bit more studious in reading them. It doesn't all just rush by like it just happened just now. So they're the two places where people can get the bulk of my work.
Okay, thank you very much.
And ANewFN, which is a fantastic website. We've got some American prices in now. It's still very much alpha. So we've got some American markets in addition to the UK market. So all those people that heard about it, tried it out before, it's got US stuff in it. Now the US stuff is arriving. It's there. So come on down.
We'll put the links down below. And yeah, please do check out Clem's channel. I encourage everyone to subscribe to his YouTube channel. I'll put the link down below. Clem, have a great trip in Japan. Where are you off to next?
Well, I'm off to the Formula One in Monaco. Back home.
Amazing. All right. You have a great time. Enjoy the rest of your May and the start of your summer. And we'll speak soon. Take care for now.
Have fun in Bali.
Thank you very much. And thank you for watching. Don't forget to like, subscribe.